Mark Todd from FIIG Securities, good morning to you now. Certainly, just give me a sense on the lead up to all of this and the way bond markets in turn have dealt with it, alongside what's been a fairly refreshing and reassuring stance for sovereigns and their debt burden of late in Europe.
Morning, Carson. How are you? We saw this in December, where the S&P came out and mentioned that they would review these agencies, and I'll make the point that the constant reviewing by these ratings agencies has made the market more cautious by nature, and they're always looking for a downgrading, they're always looking for a re-rating. So when it came out on the Friday, I don't think the market was caught too unawares, and the reaction was modest. I think the market is in a grinding mode. So they're moving into these safe havens of the bonds. You know, you get some negative yields on these bonds, and they're moving into the treasuries. And again, it's just grinding all the time. It had been such that there was a bit more risk on in the last few weeks, as people were looking to take advantage of what the ECB had done and what the Fed is doing in terms of its liquidity. So there was a little bit more confidence around buying some of these assets, and you saw that in confidence in buying some of the Italian and Spanish bonds. And that triggered, to some extent, a short covering rally. So the sharpness of the response was such that we thought people were getting caught short in those sort of currencies, those sort of bonds. But basically the market will continue to take this information. It won't be a surprise to anyone. And to be honest, you know, they're moving one notch down in the French. You know, look what happened to the US. I think the market can absorb that one notch movement.
Mark, Steve Goldman from Capstream Capital. My worry is the investor base for the European sovereign sector. We're seeing, even from our clients saying, I don't want you to hold anything other than German bonds. Do you think that that's going to be a problem going forward, the smaller investor base for these countries?
Steve, morning. I think it's a massive problem. I think what's going to happen is you're moving into different segments, whereas you know, the people who traditionally would buy those AAA rated assets are, you know, they're the PIMCOs of the world. They're different investor bases that are saying we're very comfortable with this underlying asset. We understand what's happening with their various fiscal responsibilities. Where money's being driven at the moment in terms of the pension fund money, they're being told you only buy AAAs, and if France isn't a AAA, I don't care. I don't want you buying them. And so you move into different investor segments, and that becomes a harder case to be made to impress upon Capstream. Look, French AA minus debt is a really good debt. There's greater opportunities around to take advantage of what you know.
That said, there's still a lot of money paying for the safety of US government bonds, and they don't have a AAA status any longer. Is that simply the liquidity pool as wide as the Great Lakes and all of that? Correct,
it is. It is the world's reserve currency. And that creates its own benefit. You know, they issue in US dollars, they issue globally in US dollars. You stick to where you find liquidity. There is, if you like, there's two different ways to address the return. There is what yield am I getting, and will I get a return at all? Will I get my capital back? And so if you're in a liquidity space where you can trade so much of that treasuries, you have some comfort around the ability to exercise that right.
I was just saying to Steve off air, reviewing an interview from August of last year, where the 10-year note was fetching, the yield on that was just on 2.6. Now, you know, at its lows of last week, down to 1.65.
Yeah.
Mark, how low can they go?
You read the things that the various analysts put out, and they say there's great value in the 5-year part of the curve in the US, and you have to have that out-of-body experience and look at it and think, that's great value, it's extraordinary. We're going to be in a low-growth environment for the next 4 or 5 years, I would have thought. I don't think this is going to come out for a while. You know, the Fed's already said it's out to 2013 before it starts to move zero cash rates. So zero's the base. You know, they'll grind it. It'll be, you know, every incremental point is worth a lot. It reminds you of Japan, you know, in the 90s. It was such a very steep curve eventually. It became from that zero rate out to 2%. It's a steep curve. 2% is a big number. I'm so pleased you mentioned that, and just to pull away from the bond discussion short term, but just Steve, to you in studio, the euro's trading at 97.27 yen, lowest level since 2000. You like that trade, and yet it's very crowded. Just put it into context.
Yeah, that's right. I mean, I think the world today is short euros, and the problem with that trade is that it's a very crowded trade. So you know, the timing is important. When you think about you want to be short euro, you need to be long some currency, and the problem with being long the U.S. dollar is the U.S. dollar. You're still going to see maybe QE3. There's the Fed can still print money, so that's a kind of a harder trade to put on. I personally like that trade as well, but versus the yen is probably an attractive trade because it's unlikely that the Bank of Japan prints money.
For all the known reasons. Well, Mark, back to you. France tonight, 8 billion euros in a debt auction. The help that the ECB's given to date, which you just referred to in passing before, is that going to ensure that the banks don't have that risk of a credit crunch at the moment, that maybe this one gets it passes muster?
It's a $64 question. I think the ECB have done a pretty interesting job, and they've taken a macro view. And they've said, forget Monday and the French auctions, forget the Greek default. Let's look at the effect on these banks, and we need to take a longer-term perspective on these banks, and that's the problem. So do I think they're going to go out and buy the French sovereign because it's only been one notch? Probably not. They'll probably look to take a little bit of money. They'll buy a little bit higher, and they'll try to squeeze the French as they're doing with the Greeks. So my short view would be they'll put pressure on that, and there'll be tentative buyers and looking to try and extract some sort of yield.
What's the bigger picture view now, though, on Germany? Its position that, if anything, budget deficits need to be cut regardless of the impact on economies. It's austerity with a capital A all the way.
To some extent, you could see the view that the ECB is acting in such a way that the German ability to dominate the scenario is changing. The ECB is coming back to the Germans and say, if we can't get our house in order, you will suffer as a consequence. And so the German view had been very dogmatic in its response. It said, this is the way to do it. We are going to change Europe. Basically, that's what we have to do. I think it's been brought to the German Chancellor's, opinion has changed a little bit, that the form of the job is so hard to change Europe, and the effect of changing Europe is going to have a negative effect on Germany. So it's now a case of moderation, just affect some behaviour. But I think they're getting a little bit looser in terms of how they'll respond. When the French came out with a lower rating, Merkel was straight out saying, we are going to make Europe work. We are definitely going to make it work. So I don't think they need to see themselves as the last bastion of funding. It'll create its own problem for them.
All right, let's just talk a domestic funding issuance. This is covered bonds and Combang. What are you eyeing here?
Well, the CBA announced on Friday that they would bring out a covered bond that was a domestic covered bond. And that's an interesting... they haven't given us any numbers yet, or I haven't seen the numbers yet on how much they're looking to generate. It's safe to say that they'll generate as much as they humanly can, because the point of offshore funding is still very difficult. And to be honest, the covered bond performance of the ANZ and Westpac's been weak. It went out at about 150, it's now at about 180. So it's an underwater performing asset, which is consistent with most corporate assets at the moment in terms of the market liquidity issue. But it'll be very interesting to see how CBA goes about it. I think it's been led by Citibank, and they'll be very keen to get as much out as possible.
Yeah, Westpac's there as well, and its own institutional bank arranging that offering. Mark, thank you so much. Have a great week. Value it.
You too. Take care.
Mark, Todd there from FIIG Securities.